Today's episode is part 2 with my friend Dave Lundgren. Dave has spent decades in the world of business, leadership, and investing, alongside some of the most influential minds in personal development and entrepreneurship, including Tony Robbins and Dean DeGrazio. He has helped entrepreneurs scale businesses, think bigger, and build wealth intentionally. In our first conversation, we explored mindset and leadership, but today we're diving into something very practical: real estate investing. For many Americans, real estate has been one of the most reliable paths to building long-term wealth. But it's not as simple as buying a property and hoping it goes up in value. The real pros understand the metrics, the strategy, and the discipline required to do it well. Personally, I've been out of the real estate game for a while, except for our home, which thankfully we did very well. But I know real estate can be a powerful tool when it's approached thoughtfully and strategically. So today we're going to unpack the fundamentals: what makes a good investment, how to analyze deals, what types of properties are performing well today, and what someone should know before jumping in. If you've ever thought about investing in real estate, whether it's single-family homes, multifamily, storage units, or even mobile home parks, this episode is going to give you a fantastic starting point. Dave, welcome back to The Manager. It's nice to have you.
Thanks, Aimee. It's good to see you again.
It's so good to have you back. Before we dive into strategy, Dave, I'd love to start with your personal journey. How did you first get involved in real estate investing?
Great question. So 25 years ago, I left the Army as a chaplain and came into what I would call the high-ticket coaching space. So selling real estate as an investment. And you mentioned Dean DeGrazio. I worked with him. I was his right hand for years, doing the infomercials back in the day when those things existed. And so I really started selling real estate education first. And then I really didn't start buying rentals till a few years after that. And then as the infomercials wound down, Dean came to me and said, "Hey, we're moving to live events. We're going to be doing seminars, but you're in Kansas City, Missouri, which is a great market. Take my money and let's do what we call turnkey," which we can explain, but basically selling a rental as an investment to people, to his students. And so I went from having bought a couple of rentals to we did 200 flips, buy, fix, and flips within like 18 months. So I dove in hardcore probably about 2012, 2013, and did a lot of real estate from that point on. I became an active investor because of that path. So that's a quick explanation. Yeah.
What a fun time to jump in, because the market was still pretty down at that point from the recession that we went through in 2009. We were still just barely starting to recover in 2012 and 2013.
Yeah,
I love real estate. I'm always watching the market. The market that we're in, like right now, is it a cautious market for buying real estate? What do you think? What are you feeling right now?
Yeah, it's a great question. What I used to think there was one national real estate market. The reality is it's kind of regional. So there are massive things large things that influence the entire market, right? Interest rates, and certainly in 2008 there was a trifecta of things happening that affected the entire market. But a lot of times since then, it's been a regional thing. But by and large, interest rates have been up, and so things have tightened up. And it's become difficult for turnkey real estate, or what I would call rentals, passive investing, to work. It's become a bit of a challenge, and we're going to talk about some of the solutions to that. But certainly, as you talked about, if you're buying low, 2008 to 2012, and you're able to rehab that and get a good tenant in there and just ride that appreciation. But back to the regional comment, there's a difference between like a California where you're at and Kansas City. So even those different markets, there's an affordability. Sometimes in the Midwest, you can still make real estate work. But I would say it's definitely more of a challenge than it was even 10 years ago. A lot of people got in 10 years ago, "Oh, this is easy." And the last 2 years, they're like, we're having some real challenges we didn't anticipate before. So it's been interesting to watch.
Yeah, I jumped into real estate in 2002, and you really couldn't make a mistake at that time. It was pretty friggin' easy. Like, it didn't matter what crappy house I bought in a good neighborhood. As long as I could make it cute, I could make money. And it was so much fun. I loved it. And people always come to me and ask me for real estate advice, because I did spend a decade of my life, flipping houses and owning real estate and making a good amount of money doing it. But surely the market has changed, and the savvy investors are going to do, you can't just jump in and not make a mistake. You could jump in and make a mistake. So it's being educated is going to be more important now. And also, like you're saying, regional, like California, the cap rates here suck. Like we just don't, it's hard to invest your money here and know that you're going to do really well. You're going to do well with the inflation. We're going to have inflation, so the prices of houses are going to go up. But,
sure.
It's not the passive income that, we learned from Rich Dad, Poor Dad and Carlton Sheets. And, back in those days of, you could buy something and make some money on it every month.
Yeah, and you brought up a key word. So passive versus active. So real estate investing in a very general sense, and there's a lot of different pieces to this, but there's active real estate investing and passive real estate investing. And even the great majority of folks that we sold education and training to, they thought they wanted to be active, right? They saw the HGTV. In fact, we work with Aimee and Scott Yancey on the Flipping Vegas. And people see that and they're like, ooh, I want to go flip a house. And you did some flipping. And that's fine. And you can make a lot of money doing that. But it does require work. That's active. You're in there, you're doing stuff. And then there's passive, which is, I don't want to swing a hammer at all. I just want to place my capital. And we found that a lot of folks that actually invested a lot of money in education and training realized, oh, this is actually work and there's a job. I just want the benefits. And so I've done a lot of active investing, but the great majority of what I do now is more that passive side, which is like, I just want the benefits of real estate. I don't want to have to go and be active with it. Now, some people like you are creative and like, no, I actually like to fix the thing up. But in a very general sense, people need to decide, I'm willing to go put in the work. I'm willing to put some time and effort and make it a business, or take my money and go place it somewhere and I want to return. That's a very broad statement, but I think people need to decide which category they want to be in from an active versus passive side.
That is such a good point, Dave. Oh my gosh. Yeah. Then that's really the crux of it. It really is. And as I'm older now, I'd love to get into passive, and I'm looking at a lot of properties and there's absolutely nothing. Nothing. There's nothing that is, passive income. It's amazing. You put money in and you lose money every month. So it's finding the deals. I think that's, another big part of real estate investing is that you're going to have to spend time looking for the right deal. You don't swing at every ball. You have to find the exact, in tennis, it's all about when you're doing your serve, it's like the toss. If the toss is good, then you hit the ball. But if the toss is not good, you don't hit the ball, don't take the serve. And that's,
and if you don't buy it right, you're in trouble. And to your point, even within that, there's a lot of great training and education, and people again can decide, hey, I'm going to go create a system and I want to figure out how to get, even in today's market, how can I get something undervalued, or I just want to rely on another team to do that. And I've gravitated towards more of that, meaning my partners and I, we've done thousands of deals over the last 20 years, and people that have decided, I don't want a job. Okay, you guys are in 5 different markets. You've done thousands of deals. You can document 9 years, as I mentioned via text. Now we got 2,100 investors that we've documented what kind of returns they're getting. We've created a system, and some people are like, okay, as long as I can, just like a stock. If I'm looking at a stock to buy a stock, I'm doing the research on that company. I've decided, okay, Coca-Cola has good foundation, good fundamentals in every market. Same thing with real estate. You can research the market, you can research the team and decide, okay, I don't want to have to go and deploy all these systems. If I can get somebody else to do that, that's done that for decades, thousands of examples, I want to invest into a system like that. And that's ultimately where I've gravitated for the same reasons you brought up, because the market's so difficult right now. And even with rentals, like you brought up rentals, and we can talk about all sorts of different real estate, but rentals are difficult. Even in the Midwest, in Kansas City, there's been a crunch on cash flow. So what we've gravitated towards is actually lease options. And that simply means like a rental is just a lease, right? I'm leasing a house. A lease option gives the tenant a lease, but they also get an option to purchase. Well, why do that? Well, the quick answer is instead of getting maybe $100, $200 a month cash flow on a lease option, because of the money they're putting down and because we're charging a premium on rent, because we're not responsible for maintenance, for all these reasons, instead of getting a very minimal cash on cash, we're averaging about 14% cash on cash, and a total return when you factor everything in is about 59% on your money. And people see that and they're like, oh my goodness, all day long, I want to do a lease option versus a rental. So that's one strategy that we're deploying to help people with the cash flow, because they're like, rentals don't make a lot of sense right now. Well, if we can get you $1,000 a month versus $200 a month, all of a sudden that changes the game for folks.
Absolutely. I remember this was the game even back in 2002. We were talking about, the lease, the option to purchase with a lease with an option to buy. And you're basically giving your tenant the option to lock in the purchase price. That's the benefit to the tenant. And then the benefit to you is you're going to get some cash up front, and you could basically hand over the maintenance of the property to the tenant, which is pretty cool.
For sure. And I'm actually sitting in a townhouse that's going to be my son's. I got a special needs kiddo, and this is going to be his townhouse. And I've done a lease option on this house more than once. And to your point, lease options have been around a long time, and it's usually been just a local market thing. Okay, I can do a lease option. It's better than a rental. But there's never been a national solution up until my partners and I came up. We got some software now, and we actually have a national property management. So now we can scale this just like a rental, because it's always been a good strategy, but it always hasn't been able to be systematized nationally. But you're right. You get a better tenant, and about 20% of the time they actually buy the house, right? So 80% of the time they're in there, they act like an owner, they're taking care of everything. They've given you some extra money, higher rents, a deposit up front, and yet they end up moving out, which is fine. The 20% that buy, they're buying at retail, and you're still getting your cash flow. So there's a lot of reasons why those lease options make sense from I just want to own and hold one piece of property as compared to rentals. And obviously there's other types of passive investing outside of that, but that's one way in the marketplace that we're seeing really good returns. The other thing is looking at trends, like at a national level. Okay, affordable housing, that's a real issue, right? So ADUs, I've been doing some of that in Texas, or tiny homes, or RV parks, or mobile homes. That's getting in front of this trend of, okay, affordable housing is a real issue. How do we solve for that? So that'd be the other caveat I would give somebody, is just historically looking at, okay, where are the trends? Affordable housing is a real issue. How can I get in front of that growth, or how can I help solve that problem? And you mentioned storage. I mean, anybody can research self-storage. My best friend owns 13 self-storage units. He's done very well for himself. But historically, it's the lowest default rate of any type of real estate. The challenge is, it takes some cash to get into them, right? They're millions of dollars, and it takes some financing. But that's where like syndications come into play, where you can invest with other people and be part of it. Maybe you have $50,000, $100,000 or more, and then you can invest as a group. So self-storage historically has been an amazing investment for some of those same high-level demographics you look at. People are mobile. People are moving, divorce, moving. That's what creates self-storage opportunities, because people are moving in and out. So yeah, there's a lot of different types of investment, even on the passive side. We can deploy your capital, research the team, make sure they've got a good history. And again, I'm very, very biased. Real estate historically, when done right, with the right team in the right markets, in the right type of investment, you just can't beat it. You got 4 returns for every dollar you put in. You don't get that with stocks. You don't get that with gold. You don't get that with commodities. Historically has created more, millionaires than any other asset class, for sure.
Yeah. And the tax benefits for real estate, because of the risk that we're taking as real estate investors, the government basically that has written the tax laws to really benefit owners, property owners. And so there are the tax benefits that go to real estate investors are some of the best ones out there, business owners and real estate owners. Talked about syndicates. Now, my brain is, you got me turning on this one. I'm thinking, okay, if you're interested in investing in something like storage units and you want to get involved in a syndicate of people who are going to be buying together, how do you find people like that? Where do you go?
Yeah, it's a great question. Start clicking on those ads and Meta. I promise you there's going to be people advertising to you. But all kidding aside, there's national groups, like Bigger Pockets is a free website that's out there that has a lot of free information. Now, the challenge with that is sometimes free information isn't that awesome or great. Anybody that reaches out to me, I'll give you my 2 cents on all sorts of different syndications that exist, some that I'm not a part of, right? Because I only want to work with people that want to work with me and have the specific same goals and same risk-reward things that I'm looking at, right? Because some people are in a different stage of life. An 80-year-old couple that is using all their retirement money, that's a different conversation than a 25-year-old dude who's got a high risk, high reward. So I'll shoot anybody straight and say, okay, where are you at? Where's your risk reward? What kind of returns are you looking for? And then based on that, you can make some smart decisions. So you could research. You can go into, ChatGPT and research real estate syndications. And then again, looking at the asset class. Okay, multifamily, does that make sense to me? Commercial, self-storage, a syndication of several people buying single family houses together. Development, like we do a lot of new construction development. So it's going to take some research. And there are groups out there that do provide training and education specific to passive investing, right? Just like on the active side, they'll educate you, they'll train you and say, okay, based on your goals, this is, the type of real estate asset you should get into. And then syndications it's really something that's exploded in the last 20 years, but it kind of started with, a bunch of people hanging out at the golf club, and like there's the doctor, there's a lawyer, there's the local county dude, and there's the realtor, and they just had a conversation at the golf course about, oh, hey, I'm going to put my money into real estate. Well, that has grown and grown as alternative investments have grown, and now it's become, a huge marketplace where people are like, okay, I want the benefits of real estate. I don't want to have to manage it. Let me go find a good group. And at the end of the day, that's what a syndication is you're just placing your faith and trust in a group that has a history. They're going to go do the work, your capital, their expertise, their time, their money as well. But that's what a syndication is for those folks who've never invested in one. It's like buying a stock, except you're buying into a real estate development or a real estate project.
Nice. Are they still called REITs? REITs, a real estate investment trust, or what are they called now, the vehicle?
Yeah, that's a great question. So REIT is similar, but actually a REIT is, the legal structure is different. So on a fund or a syndication, there's all sorts of different legal structures, 506C, 506D, and depending on who they're marketing to, like you can only market some investments to accredited investors, right? So somebody who's made $300,000 or has a net worth of $1 million, ironically, as crappy as this is, they get access to some investments that a non-accredited investor don't get. A REIT is just a legal structure that's actually distinct from a syndication. It's literally, again, just like buying a stock, but it's just a different legal structure. But it's the same intended outcome where you're just buying a piece of a share. Say there's 100 shares in a company, right? You're buying stock. A REIT, you get ownership in that, and it's the same concept. Somebody else is managing your money, investing into, and they have to disclose, just like these other funds and stuff, they have to disclose, here's exactly what you're getting into. We're investing into multifamily, Indianapolis, buy, fix, and flip, or whatever. So it's just a different legal structure, but very similar outcome at a high level. That's the very...
And are you looking at like quarterly dividends on those kinds of investments? Is that how it pays out?
Great question. They're all different. So some pay monthly. You can get involved in a syndication who they don't pay you for 2 years because it's maybe a development thing. And if you look at, they call it internal rate of return, which is a very complicated formula, but typically it's going to be a combination of a monthly cash flow or a quarterly dividend cash flow, and then an equity piece. Some only pay cash flow, some pay only equity, and some do a blend. And so by equity, I mean, okay, we're going to go develop something, we're going to fix it up, and then we're going to have an exit and sell it off. You can sometimes participate in that equity.
Nice.
And as you do your research at a very broad level, that internal rate of return in the marketplace. I'm not talking about you find a killer deal in your back pocket. I'm talking about, generally speaking, most syndications, they're getting somewhere between 20 to 29% internal rate of return. Meaning when you look at the cash flow and you look at the exit, again, depending on the risk reward, that's generally where the marketplace is for somebody that just wants to be passive and place their capital into something. That's where the market is right now.
Wow, that's really interesting, Dave. And you mentioned the guys on the golf course. And this is one of the conversations that I have a lot on this show, is that we as women are missing out on these financial opportunities because we're not on the golf course having these conversations with our girlfriends. We're not at brunch talking about money and how to make, yeah, it should be, but it's so loud in there. Sometimes it's hard to talk, with all the blow dryers going and all that stuff. But I don't know why we're not talking about these and having these conversations, but it makes me think, if it was something that people wanted, could the manager have its own real estate syndicate for investment? Is that something that you would help me build out?
100%. Yeah, I'd love to do that. And I love that what you're doing, teaching women entrepreneurship and leadership. And certainly for me, I love real estate as a passive vehicle, but at the end of the day, it's about that freedom and flexibility, which is important, I know, to your listeners, to you. Based on that, yes, right? As your listeners are doing their businesses or whatever they're doing to make money, if we can take some of that capital and place it and grow it, at the end of the day, what it really is peace of mind, safety and security to know, okay, the rule of 72, let me look at my return over the next 10 years. And if I can get what we're getting 59%, or you can get 29% in the marketplace, if I can do that compared to just putting it in a stock or a bond or something that's safe. And again, nothing against that, but I just saw in 2008, there were so many people I talked to that were getting ready to retire and lost half of their retirement. And again, I'm not going to tell you I can predict the next 5 minutes, but as you were saying, over the last 50 years, if you look at real estate the way we're doing it, even if the market dips, right? Like a rental house or these options we're talking about, even when the market dips a little bit, you don't sell in the downturn. We're holding these things as a 5 to 10 year hold. Cash flow actually goes up because rents go up when the market dips, and we're holding that thing over a 10-year period. So from my very biased opinion and my experience, I get real concerned when people have 100% of their money deployed into the stock market. If it's been up for 20 years, we know there's going to be a dip, and it's impossible to time the market, which is why I, as a control freak, a little bit like real estate, because I do all my measurements up front, check the market, check what I'm doing, and then once I deploy my capital, I know I'm good for the next 5 to 10 years. I'm not worried about 5 months. I'm not worried about 5 minutes. I know over time that thing's going to work out. So I would love to help you and your listeners, anybody. We could definitely create a syndication. We could create a fund and collectively invest together for sure.
That would be really fun. I think that it's something that we've, as women, have been missing out on the opportunity to grow our wealth. And I think that more women are coming into money right now than ever in the history of the world, with the millennials getting basically the baby boomers' inheritances. So it's like we're coming into billions of dollars. I actually had a woman reach out to me last week, and she wanted to invest in real estate. And I thought, how can I do this safely? She's pushing 60, and it's a different game when you're 60 than when you're 25. And, this seems like a safer way for us to work collaboratively as women to do something that we move with a bigger group of people, more money, more with system strategies, and a really well thought out approach to real estate versus just trying to act as individuals without the knowledge, without the systems. I think that we have to leverage what we have, which is each other. And then all of our resources, our human capital, like people like you, Dave. And that's how we as women are going to do this better together. So I don't know. I just crazy idea. I get crazy ideas on my show. That's happening.
I like it. My little burst of inspiration, as you were saying that, it made me think about the relationship capital, right? In any transaction, any business transaction, there's relationship capital, there's money capital, there's time capital, and there's knowledge. And women are phenomenal at networking and relationships. And I think about a colleague of mine named Morgan. She's incredibly smart, she's a financial broker, but talking about network, she actually has some solutions that don't require any money to do a large deal. Like we're talking about a $50 million or more, and it's called a bond and equity play. It got me thinking about women in your side of your network. They can come across deals. They don't have to have the capital. We can find the solutions for them, and they can create equity and they can create cash flow and be a part of the deal, even if they don't have money, just because of their network. So yeah, there's a lot of power in those relationships, and relationship capital, I promise you, has got me the best possible return I've ever had compared to money, time, anything else. Relationship capital is a real thing. And so creating a network, that's a big deal. You could certainly do that with your reach.
Absolutely. Well, I know in my business, my biggest contracts have come from relationships, not from hard work, not from sweat, from getting to know people, taking care of people, doing the right thing, and then them doing the same thing with other people. And it's just the most amazing thing. And leveraging relationships, like what we talked with Scott McGregor and I talked about on the episode a few weeks ago. If we could leverage these relationships to help us grow real wealth, we are going to be on to something. Having these conversations and then going into, really starting to understand this stuff, which another thing we talked about, one of the terms we talked about earlier was the cap rate. Could you explain what a cap rate is and why it matters when evaluating a deal? Because this is real estate basic language, but you got to learn the jargon.
Yeah, that's a great question. So cap rate is a commercial term, and it's just one way, like you're saying, to measure a return. And it's a very quick way to okay, let me size up this deal. And long story short, it's just taking the gross amount of income against how much you invested. So $100,000, if you invested $100,000, or excuse me, if you got a $100,000 return on something that was $1 million, that's a 10% cap rate. So it's just some way that somebody in very quick 10 seconds can say, okay, cap rate is this. But there's other things like cash on cash return, which is, okay, how much money did I put in, right? So the same $1 million property, if I didn't buy it cash for $1 million and I leveraged it and I only put $100,000 of my own money and I got the bank to put in $900,000, now we're talking cash on cash because we're only measuring how much cash I put in. That's a different measurement. So cap rate's a very quick, easy way for people to look at a commercial or a real estate investment and say, okay, cap rate's 3, cap rate's 10. and size it up at a high level, whether it's going to fit inside of their buy bucket.
That's awesome. And then the other question I had for you was, because Wall Street's been investing in single family homes, and now it looks like we're passing a law so that they can't do that. How do you think that's going to affect single family real estate markets in the short term?
That's a great question. And I'm not a fan of big government in any shape or form. Like, I'm very much like government should stay out of everything to do with life. So I understand why that legislation is popular, but my experience is the market will always correct itself if the government stays out. But the government's not going to stay out of it. So it certainly will have an impact. And I understand it. I mean, it's really people trying to impact their affordable housing. So I get it. It's like, oh, these big institutions, which, by the way, think about that. The biggest hedge funds who have a lot of money to do a lot of research, what are they doing with their money? They're putting
real estate.
Right? So
Yeah.
It reminds me of Burger King never underwrote where to put a Burger King. All they did was go across the street from McDonald's. So just pay attention to, BlackRock, what are they doing with their money? Oh, they're putting it here. Why are they doing that? Well, there's a reason. But I would rather approach it from a let the market correct itself. But it will have an impact for sure. If it passes, I've had a lot of conversations, and I do a lot of new construction and development that way, and developers, people that are doing the build to rent, right? Developing some just to give it to rental, turn it into rentals. It's certainly going to have an impact. But the last article I read just last week, we're still 4 million houses short on a supply. So even with the big money moving in from hedge funds, we haven't caught up from 2006 to 2007, 2008 when construction loans stopped, that there's still massive opportunity, and there's still a lot of opportunity to help solve for the affordable housing. So yes, it will have an impact. I wish they'd stay out of it. And another business that we had talked about, we're trying to solve affordable housing from a different angle, which we're helping builders cut their costs using steel framing versus wood, and some other things. But yeah, it'll have an impact. But there's still a massive opportunity out there because we have such a shortage of supply in housing, and we have for decades.
Yeah, and it makes me think, maybe we go after something a little safer, like a mobile home kind of project, because, you're solving for affordable housing with that, and you're kind of staying away from the SFR with that. So that I feel like that bubble might be a little safer, and then the storage, of course, is also kind of out of the fray of those legislative changes that are happening, and the investing that's been happening kind of what I understand, those guys were basically buying the real estate in the neighborhoods, holding on to it, and then selling it to each other to make their paper look better. So kind of was a little shady what they were up to.
Yeah, well, and realize they're coming into the mobile home space as well, in the RV
Are
space.
they?
I mean, hedge funds are buying up, and a lot of syndications are focused on that for the reasons you pointed out.
Yeah,
because they make a lot of sense. It is solving for affordable housing. And there's massive tax benefits. Like with tiny homes and mobile homes, they're actually not considered real property. It's called chattel. That's a legal term. And we sell it because some people just want a massive tax return. So like, all kidding aside, and I'm not a tax expert and I'm not a CPA, do your own research, but section 168 to 179 of the IRS code, shows you that if you invest into something like that, like you put $100,000 in, year one, there's like $500,000 write-off. So if somebody's about to cut a check to the IRS for $500,000 or even $100,000, you can invest into things like that and literally wipe out your tax bill. So sometimes the investment is just not paying taxes. Even if it's got a cap rate that's very low, well, you just saved yourself a ton of money because you didn't cut a check to the IRS. Unless you enjoy cutting checks to the IRS, then it's probably not for you.
No, and we've had Barbara Shrehan on the show before, and it might be kind of really cool to get the three of us on a show because she's the tax coach and she's amazing, and she knows real estate really well too. She would be fun to bring in on this conversation with us. But yeah, there's just a lot. It's a dynamic topic, and it's the more you know. And what do you think about technology? It sounds like you guys are leveraging technology to basically have easier, systems for analyzing deals.
Yeah, for sure. We use AI a lot on the acquisition side, to your point. Take as much admin as we can out. I mean, using still framing, that's a technology thing, although it's a bigger technology play. So yeah, we're absolutely leveraging AI in our business systems. Now, the cool part about real estate investing, it's always going to be there, right? There's always going to be this. And I'm telling, not to get a little off topic, but I'm telling every kiddo, especially like I've got a 19-year-old son who wanted to go to college. I'm like, bro, go learn the trade, go learn HVAC, go learn plumbing, go do that for 5 years, learn that, create your own business, and then by the time you're 30, you can sell that thing off because private equity and hedge funds are buying that as well. So technology for sure has an impact, and AI is having an impact on our entire world and our space as well. But the cool thing about real estate, or maybe one of the challenges, is those trades are becoming more and more rare where kiddos are not wanting to go into that, which creates an opportunity for somebody who wants to learn how to be an electrician, who wants to learn plumbing and HVAC, because that's not going away. Even though I think at some point, for sure, robots are going to be doing a lot more than they're doing today when it comes to building. And we certainly want to get steel framing into the marketplace from a technology and saving trees and all sorts of things. But yeah, it's going to take a while for AI to completely wipe out home building, I think. But we'll see.
Yeah, absolutely. I couldn't agree with you more. I have, my 16-year-old, and we talk about it all the time. He's constantly talking about what trade he wants to go learn because he's not an academic.
Yeah.
He's a good ball player. He plays baseball, and he's like, I'd rather go learn a trade. And I'm like, yes, go learn a trade, and then go work with my brother. My brother's a contractor and does project management, and he could learn so much. I learned,
learn what they're doing.
Yeah, learn skills. Now it's all about learning skills now, real life skills.
Yes, and then he learns from your other family member. Then he starts his own company because there's a multiple. Private equity already has a multiple on that exit, and they're looking to consolidate that as well. So he, legitimately go work for somebody else for 3 or 4 years, learn it, go start your own business, and in 10 years, he could exit and do really well.
Yeah, the kid loves money, so I think he'll do really well. He's just trying to figure out his path. We'll have a conversation with him.
Love that. No, he's 16. Yeah.
Yeah, exactly. So, I love this. Another piece of real estate jargon is when investors ask, what's the mix? Can you explain what that means and why the unit mix in a property matters?
Yeah, so that's typically referring to, again, this passive idea where you're investing into a syndication or a fund. And the mix is going to be like, we're talking residential, commercial, and even inside of commercial. Is it self-storage? Is it a strip mall? And so the mix is just, and even the unit mix sometimes, even if it's all residential, how many of those are 2-bedroom, 3-bedroom, 4-bedroom? And that matters because, again, just think about at high level supply and demand. The most demand you're going to have in any market is a 3-bedroom house. That's just reality, right? So if it's a huge mix of 1-bedroom houses, to use an extreme to illustrate the point, like, I don't really want to have a bunch of 1-bedroom houses. That doesn't make a lot of sense, right? So that mix tells you what's inside of that actual syndication or fund, both commercial, residential, and then diving deep, not just the type of commercial, but the unit mix. And again, people can do their research and just see historically what types of mixes do the best and what, the national averages are. That's one way you can use AI. I mean, AI can help you do a lot of research very quickly that we didn't even have even with the internet 10 years ago.
Yeah, I was looking at some multifamily properties last year, and it was the first time in my life that I've had AI to help me analyze the data. I mean, I usually just crunch out my own numbers, and I know how to do that from all the olden days 20 years ago, but it was so much fun to work with chat and be like, hey, what's the cap rate on this? And, do you think this is a good investment? And here are the details on this property, and to really just kind of talk about the property and give it more information than it could just get from the listing when you go and visit the property. What do you see were the upsides and all these things? And it can really help you analyze a deal.
Yes. And as a lot of people know, with AI, it's that prompt. And so even diving in, hey, this is who I am, this is how old I am, this is how much money I have, this is what I'm looking for, here's my risk reward profile. The more information you give to chat or an advisor, the better they're going to be able to steer you in the right direction. Like, okay, you're 80 years old, you're 60 years old, this is your retirement money, cash flow matters, right? AI is very helpful. As long as you're giving it the right prompts and asking the right types of questions, it becomes even more powerful.
Absolutely. So this is kind of a basic question, but there are so many different types of real estate investments today. From your experience, how do these compare? Like single family homes, multifamily apartments, mobile homes, self-storage, commercial real estate. What do you think is performing well?
Yeah, that's a big, broad question. The quick answer is, well, it depends. And when I mean that, again, it depends on somebody's risk reward, what they want to be doing. And so anybody can look up historical averages. Anybody can research any particular group. But I mean, multifamily's taking a bit of a hit, right? Because a lot of people were developing, interest rates went up, and it became really tight. So I personally know a lot of syndicators who were doing development who things became a little bit tight for them, which is where I'm very biased. But like if you've got a bunch of single families, you can pivot quicker, right? And especially if you've bought them right. Again, I'm not talking about being in the urban core somewhere, but if you're in a decent neighborhood like in Kansas City, you've got more flexibility. If you own 10 single family homes, for example, as compared to like one multifamily, because your buyer pool is so much smaller in a multifamily. Again, it really depends on somebody's risk reward, what they're looking for. But if you look at the historic averages, things like self-storage in the right location, things like having a bunch of single family, and even Warren Buffett, right? Captain Stock Market, he talks all the time about it. And if you look at his company, Berkshire Hathaway, they've invested all around single family homes without buying them because he wants to be part of that services piece of real estate. But he said you have to find a way to manage those. So that's the challenge with owning single family, which is why having a property management company that's vested and has a long history, or in this case, lease options. That again, we've got over 2,000 investors we worked with. That takes the difficulty out of owning a bunch of different units versus I'm just going to put my capital into a syndication. Yeah, I would not recommend at scale if you want to be passive, right? Don't tell yourself I'm going to buy 5 rentals in my backyard and call that passive, because it's not going to be passive. It's going to be you're dealing with tenants, you're dealing with toilets and trash. Turn that over, if you really want to be passive, turn that over to a professional property management company who's vetted, has a history. Otherwise, you just created another job. Just like back to that active, right? Don't tell yourself, oh, I want all the benefits of real estate, but I'm not willing to go swing a hammer. I'm not willing to put some money into marketing. I'm not willing to go drive around. It's like, no, you want to be passive. You don't want to be active,
Yeah, I have neighbors in my neighborhood, and they about probably 10 or 15 years ago, they started buying up houses in the neighborhood. So they own a lot of the rentals in the neighborhood. But I have to say, like, it is not passive. There are toilets, there are rats, there's gardening, there's, there's just a plethora of upkeep that needs to be done on the houses. So, I think they probably bought them thinking this was going to be passive income, but it definitely is another one of their jobs to manage the rentals.
That's impressive if they're buying in Southern California.
Our neighborhood 15 years ago was very affordable. It's just in the last couple of years, we just had a house go on the market for 2.5 million on the busiest street on the corner, the very edge of the neighborhood. And to me, I'm like, it's so overvalued. And that's what makes me think like the bubble has to pop a little bit, at least in some places. We have it seems like, oh my gosh, there's no way that the properties have gone up this much in like 6 or 7 years. But this is a house that was probably worth $700,000 like 7 years ago.
Yeah. Well, 2.5, that is the top of the market. That's why I chuckled. In Kansas City, 2.5 million gets you're on a private lake with your own boat dock and a huge mansion for 2.5 million. So, it's funny.
Oh yeah, California is a whole nother animal. And it's not, this is not a place, if you're looking to get into real estate, this is not where you get into real estate anymore. You can't do it here. It's just not something that's, feasible. So it's, looking at doing the syndications kind of cool because it's a way for me to get back into real estate and to be able to do it in some other location, because I've been trying to get back into real estate here. My husband's like, I want to invest in real estate. And I'm like, okay, I'm going to shop it. And there is nothing, Dave. Yeah. It is.
Live where you want to live.
I can't make it work. Yeah.
But invest where it makes sense. We met out in California. Beautiful. Right? People can say whatever they want about California, but there's a reason people live there. It's absolutely gorgeous. But yeah, if you can't make the numbers work, then go invest in some place that does make sense where you can actually get things to cash flow, in the right market with the right team. But yeah, 2.5 million, you could do a lot with that.
I was talking to a young man who invests in mobile home parks, and I was telling him what I was looking at. I'm like, oh, I was looking at this 4-unit, and he's like, do you know how much real estate, how many units I can get you for $1.8 million? He's like, you could get like 100 to 150 units in other states for this. And I'm like, wow,
Even states that have massive growth, and it can likely continue to have massive growth, like Texas. I've done a lot of RV parks, tiny homes in Texas. I still think massive growth is coming there. And it's yeah, 2.5 million, you can get a nice park.
Yeah, totally. And I've got my brother who's out in Arizona who project manages and could help us build whatever we want. I mean, he can take it from dirt to he could
Yeah.
build. He's basically built like sky rises with pools on the roof and stuff. I mean, he's built absolutely everything. And to me, I'm like, why would I take that same capital here and put it into something that isn't going to have the type of, it doesn't have the type of growth and potential that I could, you're planting your seeds. Our money, our capital is our seeds. And it's like we have to choose what soil to plant it in so that it can grow to be the most, the biggest tree possible. And it's California for me is not that.
Yeah, and then back to your point, rich dad, poor dad, have those assets kick off enough cash flow to pay for that beautiful house in California, right?
Yes.
Deploy that,
Yes.
get more cash flow coming in, pays your mortgage plus extra. Now, for just purely logical, purely mathematically, you're ahead of the game, right? Because that house in California is it might dip, but it's gonna go up over time. But
Yeah.
you have an asset now that's paying for that versus it's just sitting there.
Absolutely. Yeah. And now that income, that passive income is something, I'm 47 now. And I looked at my husband and I'm like, babe, we're running out of time for our retirement investment. You are there. Like we're right there where, we need to start getting serious about it because, our companies are awesome and they create a lot of income. But having that passive income in our retirement when we hit 65 is going to be kind of a game changer for our peace of mind, just to know that it's there. No matter what happens with the companies up and down and whatever happens, I feel like it's a beautiful thing. It's what I know. From Rich Dad, Poor Dad and Robert Kiyosaki and all these guys that, I got all of my early training in my early 20s from. I'm like, why don't I have this? This is something that I was starting to build when I was in my 20s and now I'm in my 40s and I don't have this. So for me, I'm like, okay, it's time to get back.
Yeah. Well, you got the cash flow, you got the business, you've done a really good job with that. And you got your brother as a contact. We could certainly create a network. So you're still in the game and you're still young, 47. I mean, and that's where the rule of 72, people start to really analyze, okay, what does 7% get me? What if I get 30%? How quickly does that change the game? And that's where it becomes exciting, where you can move the needle very quickly with real estate. Again, caveat, done the right way with the right team, She can lose money in real estate, by the way.
Oh,
Just take
I
the
mean,
obvious.
that was the thing. I stayed away from real estate because 2007, 2008, and 2009 were the three most stressful years of my life. And it was when I was becoming a mom and I was just like, I exited real estate in 2011. When I was about to give birth to my second son, I just said, I just can't do it anymore. I just can't handle the stress. And it's not just paying the mortgages. It's like also paying the property taxes in California, which are cumbersome. And I just couldn't take the stress of it anymore. I was like, no, I've moved into a different season of my life. I am a mom now and I don't want to deal with the stress. So now that I'm older and wiser, I want to go into real estate investing really more. Instead of being an active investor, I'd really like to be more of a passive investor, knowing what I know now and just focusing on cash flow, really playing the cash flow game. Robert Kiyosaki has a board game called Cashflow Girls, and you should get it and play it with your kids, play it with your husband. If you want to learn about real estate investing and basically how to create passive income, how to build wealth in America, play the game. It's so much fun. And it's really a good use of your time. Also, so when you're personally looking at potential property, what are the three most important metrics that you analyze before investing?
Good question. So does it align with my goals at a high level, my risk reward, right? The team, right? Are they doing it? Yeah, I think the market. And I would say this, like the team is way more important, meaning like I've owned C-class properties in the urban core of Kansas City, and I've done new construction. All day, every day, I would rather have a C-class urban core rehab if it's the right team versus, because I've lost money on new construction in beautiful markets as well. So the team is really, really important. And then know where you're at in that cycle, right, in the market, right? So like the risk reward in 2002, when you jumped into flipping in California, it's like, oh, the market's just screaming up. Everybody thinks they're just a genius. They're just riding that market, right? Versus, oh, the market's been up for a while. Do I want the risk and reward of a high retail flip versus no, I just want to put my money in passively and sit for 10 years. So knowing those strategies, to me, that's what I look at for my personal investments. Like where do I want my money to grow? Who's the team? And is it going to get me in alignment with what I want, which is, using my skill set, but getting me the highest possible return at the lowest risk. And the risk is really not knowing what you're doing, right? Which is where the right team comes in. Because if you know what you're doing, there's actually less risk. Whether it's the stock market, commodities, or real estate, the risk is in not knowing what you're doing.
Yeah, absolutely. Which is my next question. What mistakes do you see new investors make when they're evaluating a deal?
Yeah. Well, one is that first thing, active versus passive. Oh, I want to go flip a house. Be honest with yourself and know what that really means. I don't care what an educational person tells you, it's work. So once you've decided, okay, I'm good with that. I'm good with the blood, sweat, and tears, and I'm willing to put some effort in. Cool. Then you can wholesale, you can do creative financing. There's all sorts of active. If you want to be passive, again, back to this risk reward. Where am I at in my life cycle? How much money do I have to deploy? Is it more important for me to get a safe, solid return and get 10% of my money? Or am I willing to risk a little bit more? So those are the things that I would factor in. And everybody has to make that decision for themselves based on where they're at in their life cycle, how much money they have to deploy, and their own gut check on risk reward personally.
Heck yeah. What does a bad deal look like on paper to you?
On paper? Man, they all look good on paper. I would say that the bad deals are if it's a bad operator, right? Do your research. Oh, this person's never done a flip. Oh, this person's never done, on paper, you can research that and find that out. But I would say speculatively, like a lot of people are like, oh, like in the rental market today, right? And I've sold a lot of rentals, but right now I'm not advising somebody, oh, go invest in a market that's typically been an appreciating market. And even if it's just cash flow even, you're not making cash flow, bank on the appreciation. To me, that's risky because appreciation is a nice bonus over time because we have a currency. We keep printing money. To your point, inflation is going to be there.
Yeah.
But you don't know what's going to happen with that market. Like Florida, right, is starting to soften up. You don't know what's going to happen. And if you're expecting to buy something in a market like that and turn it around in 6 months, I think you're fooling yourself. So back to your point, cash flow is king because if you buy the right property in a good market and it's cash flowing, even if there's a 10, 50% dip in the marketplace, like we saw in Kansas City, even in 2008, it didn't bottom out, but it dropped 15%. We'll just write that out because it's cash flowing. So to me, anybody that's telling you, hey, buy a property, and even some folks are buying property that are inverse, right? They're actually not cash flowing. They're like, oh, it's going to go up. Yeah, but what if it takes 10 years to go back up? So to me, on paper, anybody that's pitching something that's a break even or very, very minimal cash flow, to me, that's scary. That's speculative. And especially for newbie investors, right? Now, if it's a hedge fund and they've analyzed and they got that's a different conversation. But somebody's got $100,000 and that's their last $100,000 they're doing in retirement. No.
Absolutely. That's such good advice. And then for people who don't understand cash flow is like you've got your mortgage payment and then you've got what your people are paying you in rent. So cash flow is anything over that mortgage payment, over your mortgages and the cost of that property. So you've got your property taxes figured in, whatever other costs you have, and then whatever your guys are paying you in rent. If that's more than the cost of the property, you've got cash flow.
Yep.
Yeah.
For sure.
Yeah, just so because the girls, we're educating everybody now. We want to
come back to that. Yeah,
Just because I grew up on this stuff, but not everybody did, and I want to make sure everybody can catch up. It's time for us to all catch up here. So we're in an interesting market right now with higher interest rates than we saw a few years ago. How does that change the strategy for investors?
Yeah, great question. I mean, it does. Whether you're a developer or whether you're buying rentals, because if you're buying a rental, you got to have a loan on that. Which again, I'm biased, which is why we're getting into lease options because we're getting so much more cash flow, right? Across the board, I talked to a lot of turnkey providers, and they're $100, $200 a month. That's kind of typical. Where we're getting $1,000, it just gives us a lot more cushion because somebody's willing to pay a higher premium rent. Plus, we got that initial $10,000 to $20,000 down, so there's a cushion, right? So if the market shifts a little bit, but interest rates for sure have had an impact. I mean, it's made it more difficult. A traditional way of buying and holding, it's made it more difficult for developers even because their debt, the money they're getting from the bank, is up, which again contributes to this affordable housing issue. So it's real. I mean, interest rates, and they're still historically pretty low in this.
Exactly. Yeah. And 6 is actually quite the average. I mean, you look at the interest rates during Reagan, it was like 18, 19%.
Crazy.
Yeah.
Now, on the active side, there are some strategies, right? Like subject to or creative financing where people who locked in a 3% mortgage, they got a little bit of equity. You can go in there and say, hey, I'll give you that $30,000 you want. and you hold the paper for me, and then I'll make the payments. Now, again, I'm not a legal expert. That's a creative financing approach. You've got to over disclose what you're doing. But there's ways to take advantage of, because people that are sitting on a 3% or 2.5% or even a 4% mortgage right now, that's like gold. And that gives you some negotiating powers to be creative, even on the commercial side, right? If you're sitting on a bank loan that's a long-term loan and it's under 4%, that gives you a lot of power. And so there's some creative strategies you can utilize to take advantage of that long-term debt that was locked in at a very low interest rate as well.
Yeah, absolutely. That's one of the old school things my parents used to do when we were buying real estate when I was a kid is, they would often have people carry the paper on the houses for them, which means the person who owns the house free and clear basically becomes the bank and gives you a loan. And I've done this actually. I bought a house in Eagle Rock, and the sweet little old lady who sold me the house wanted the cash flow. She wanted to have that monthly payment from me. So she was the bank. I gave her, I think I paid her like $20,000 down on that house. And then we went to the escrow company, get right down the street, and we did the paperwork together. And then I just made her a monthly payment. And then I flipped her house. It needed a lot of work, but I went in and leveled the floors and made it cute and turned around and sold that house a year later. I thought I was going to live in it and stay in LA, but I didn't like living in Los Angeles. It was in Eagle Rock, and the traffic was just too much for me, and I was too far from the ocean.
And I did the same thing with a beautiful lake house here in Kansas City, and it was an older couple. They'd lived in it forever, had no debt, and they were like, well, no, why would we take payment? Like, it freaked them out. I said, well, go talk to your attorney, go talk to your CPA, but here's what I'm proposing for you. I think tax-wise, it's actually going to be better, because if I give you $1 million for this lake house, you got a massive tax benefit or tax hit. And they came back and they said, oh my goodness, this is actually way better for us. Our CPA is telling us to do this, because they became the bank and received payments, to your point. And so just educating people sometimes it's a fit, sometimes it's not. But the more you can educate them, it's like, I'm not trying to take advantage of somebody. I'm just educating you. You can take the tax hit, take the $1 million, or let me make the payments over time. And from an entrepreneurial standpoint, the more value you create for people, the more money you're going to make. And that's when creative financing works, is when you're really diving in and understanding that person's situation is, okay, I can solve your problem, and at the same time, I can make money. We both win. You okay with me making money? Yeah. Okay, cool.
Yeah.
There's a lot of those opportunities in today's market, because people did lock in rates and they're still motivated. They want to get out of stuff. And there's ways to structure that help them from a tax standpoint, for sure.
It's so cool. It's one of my favorite things is the creative part of real estate. I love the creative side of it. I really do. And that's creative financing is another really cool way to make the deal going in. And it's, often overlooked by a lot of people who are novice investors.
Yeah.
Yeah.
Sure. And even the lease option is a type of creative, because we're helping people who maybe need to fix their credit, and we go in and actively help them fix their credit. Like, oh, I can't buy right now, my credit's bad, but in 2 years I can. It's a way of helping homeowners, the 20% that end up buying. It is a creative way to get them into home ownership, which feels good as well.
Heck yeah. I remember when I bought my property in Laguna, I bought a 6-unit building in Laguna when I was 25, and I had some of the money. It was $2.5 million. And so I had some of the money, but I didn't have all of it. And basically I couldn't get a traditional loan for it because I was unemployed and I was 25 years old. I was a real estate investor. So what I did was I got a hard money loan for $1 million and I put $250,000 down. And a year later I could qualify to refinance that house because I'd proven that I could make the payments every month. So there's a lot of creativity that goes into making the deal and making it work, but you got to learn the nuances within real estate, especially within the finance side of real estate.
And that's where relationships are crucial. I got a local bank I worked with 17 years. Yeah. They don't ask about anything. They just ask about the deal, right? They're not asking for tax returns. They just, we got 17 years together. Tell us about the deal. So relationships on the financing side are huge too.
Well, that was that $1 million that I got. I had just been at Maui Masterminds, which was with Robert Kiyosaki, and I had met a man who did hard money loans while I was there. And literally, 2 weeks later, I needed him. Called him up and said, "Hey, look, I need $1 million, and I need it in 3 days. Can you do that?" And he said, "Sure."
For a cute 25-year-old, yeah, I can do that.
I mean, that was gorgeous. It was as is, but the ocean views, like 180-degree ocean views, ocean side of Pacific Coast Highway. It was a property that I'd had my eye on since I was 14 years old. I used to ride my school bus by it. And I always I always wanted to make it cute. It always looked like it needed love. And it had a lot of potential. It was built in 1922. I love 1920s properties. They're my absolute favorites. And it was, for me, I knew it was my house. I was supposed to get it, and I just needed to figure out how to make it work, and I did. But all of the pieces, the relationship part is such a huge piece. It's always a gigantic piece, and that property is worth like so much money now. I think it's worth about $4 million now. I that's the property that I bowed out of in 2011. That's the Great White Buffalo. It's the one that got away that I should have just hung in there.
Yeah, it was painful at that time.
Yes, yeah. I was almost there though. If I would have just held on to it for another 18 months, I would have been through it. And now that I'm older and more mature and I've given birth all these times, now I realize when it gets really, really, really bad, it's almost over.
Yeah, that's a good point. That's the maturity you have now.
Yeah, at 20, I would think I was like 31 when I was like, fine, I give up, screw this,
Yeah, I mean, think about that. Some people, $1 million hard loan, but you analyzed it. It was the right deal, and you had the guts and the fortitude to even take out $1 million hard money loan. That's impressive.
Yeah, well, I saw the money. I saw that the thing had tremendous upside potential. It was already, cash flowing even at that time, 1.25, and that property did really, really well. I really loved that one. Oh, and it's such a beautiful house. Every time I drive by it, I'm like, oh man, I used to own that.
Now, one thing I would say, because you're bringing up emotion, which is we all have emotions, right? And we all make decisions on emotion. But when it comes to not your own personal house, but investments, the less emotion, the better, right? So, I want to be in my backyard, or this house was cute. I would say don't look at any pictures of any house or any investment. Look at the numbers, and as much as you can. Again, we all make decisions based on emotion, but there's a very different emotional decision with your own house versus investing into something that's a business investment. And so as much as you can take the emotion out of those, the better. But
you're so right. But intuition really did lead me in the right direction. In my 20s, my intuition led me in the right direction with real estate. I mean, very much the feminine intuition of I would really know when it was a property that I was going to get. It was like amazing. It was just sort of this knowing that I had that was, and it was kind of emotional, but it really was like I would have dreams about real estate. It was very interesting. Yeah.
Well, the intuition part, I would say, supersedes everything, especially like you're saying, the feminine intuition. Like, trust your gut. Even if the numbers are good and you're like, that dude or that person, like it just doesn't feel right in my gut, run. So trust your intuition over anything, for sure, I would say.
Yeah, I think that
brain at home, but
Yeah. Look at the numbers, analyze the data, but trust your intuition on contractors. Trust your intuition on, real estate agents. Man, did I have a real estate agent that tried to run a game on me? I was 23. I might have been 22. I was selling my first piece of real estate, and this guy, I basically had showed the property to a lady. She liked it. She was like, I'm good. I got her number. She was so cute. We just kind of she's like, I really want this house, but I'll get your number because I want to be able to keep in contact with you on it. And this agent basically told me he only had one offer and told me that this other lady never put an offer in on it. But she's texting me going, I already put my offer in. He's got it. And so this trust your instincts that sometimes these people will run game on you. And I had to call him out on it and say, hey, look, she's texting me. She's telling me that you have this other offer. That was a better offer for me, not for him, because he was double ending the other deal. So he wanted the double commish.
Totally.
And so he, so you do. I mean, trust your intuition on people. But that was the first time I went, whoa, man. Like, I didn't realize that people could be so sleazy. But, in every industry, you will come amongst the sleazy people. Whether it was in the film industry, the real estate industry, there's always going to be some sleazy people. And you really do have to trust your intuition as a woman.
100%.
And as a man. If you've got that, go with it.
Yeah. If you don't, get a divine feminine in your world and trust her gut.
Exactly. So do you believe that real estate is still one of the best vehicles for building wealth in America today?
100%. Yeah, for the average American that just wants to place their capital and let it grow, for sure.
Nice. So if someone listening right now wanted to start investing in real estate within the next 12 months, what steps should they take first?
Well, reach out. You're going to start a network. So reach out to Aimee for her network or reach out to me. And again, I'm happy to have a conversation with any of your listeners. And the more I know about them, the more I'll be able to say, oh, I actually have some stuff that might be helpful. But if I don't have something that fits and aligns, I promise you I'm going to point you in the direction of like, no, this is why it's not a fit for us to work together. But here's 3 other options you have. And I will never talk somebody out of saying, I want to diversify. I want some of my money in gold. I want some of my money in stocks. Okay, that's cool. I would never say you're stupid for doing that. And so I'd love to have a conversation with anybody that's interested in real estate investing, be it the active side, be it the passive side. And again, whether we end up working together or not, I'll point you in the right direction. And Aimee is going to create a real estate network anyway, so just go through her.
Thanks, Dave. And what would you tell someone who feels intimidated by the complexity of real estate investing?
Yeah, get somebody who knows it, somebody that understands that game. Just like in the stock market, you get a broker. Same thing. You got to find a good broker. You got to find somebody you trust. That's really what it comes down to. Somebody who's got history, who's done all sorts of different deals, can show a track record. That's a big deal, which is why I enjoy the partners I have now. I mean, we can document, existing right now, 2,100 investors who are averaging 59%. That's a big deal. That doesn't mean there's not going to be issues. That doesn't mean there's not going to be hiccups, right? If you own 10 lease options, you might have a bad tenant in one of them, but you got these other 9 to figure it out, and we'll work through those things. Yeah, that's my quick answer to that.
Cool. And finally, if you gave one piece of advice to someone starting their wealth building journey through real estate, what would it be?
Know who you are. Know what you want. Be really crystal clear about what you do want. Like, hey, these are the most important things for me. This is the cycle of life I'm in. And based on that, then somebody could advise you, because it's going to be a radically different conversation based on what you say you want out of it. So be honest with yourself. All change starts with honesty. And once you do a real assessment of where you're at, where you want to go, then somebody that is trustworthy can help you from that point, I would say.
Dave, you're awesome. This has been such a valuable conversation. Real estate can feel intimidating from the outside, but when you start to understand the language, the metrics, and the strategy behind it, you realize that it's really about making thoughtful decisions over time. For so many people, especially women who may not have been invited into these conversations historically, understanding how wealth is actually built is incredibly empowering for all of us. Real estate is one of those tools that, when approached with education and discipline, can create generational impact. Thank you so much for coming back to the Manager Podcast and for sharing your experience and wisdom with us. And for everyone listening, if this conversation sparked something in you, if you've been thinking about investing or learning or taking more ownership over your financial future, this is your reminder that it's never too late to start. This is Aimee Rickabus, and this is the Manager Podcast. Dave, where can we find you?
Just my site, Dave. What is it? Dave Lundgren, dave-lundgren.com.
Dave-lundgren.com. And on social?
Yeah, same thing. Dave Lundgren, Lundgren. I'm on all the socials.
And we will put it in the show notes too. And thank you, Dave. We love you.
All right. Appreciate you, Aimee.
Appreciate you.